Viewers at home, you are welcome to my presentation on corporate failure and restructuring. Corporate failure and restructuring. If this is the first time of your joining us on this YouTube channel, please don't forget to click the red subscribe button and also turn on the notification bell icon so that you don't miss my upcoming videos. If you are a returning subscriber, I say thank you and God bless you. In this lecture, I will examine the meaning of corporate failure, meaning of restructuring, definition of the various terms or terminologies used in connection with the corporate failure and restructuring, causes of financial distress or causes of corporate failure. Corporate failure occurs when a company cannot achieve a satisfactory return on capital over a long period of time. Corporate failures occurs when a company cannot achieve a satisfactory return on capital over a long period of time. When a company cannot achieve a satisfactory return on capital over a long period of time, corporate failure is said to occur. If this situation is unchecked, it may lead to inability of a company to meet up their financial obligations. That is, if this corporate failure, if this situation is unchecked, it may lead to the inability of a company to pay their obligations as at when due. If the company is in financial distress, corporate failure may follow. If a company is in financial distress, corporate failure may follow, unless the company can be, unless the problems can be identified and corrected. I've told you that if the company is in financial distress, corporate failure may follow unless the problems can be identified and corrected. Where the problems cannot be identified, where that problems cannot be corrected, then corporate failure may follow. So I want to examine the terminologies used in connection with the corporate failure. Definition of terms. Definition of terms. Definition of terms. Number one terminology I'm going to examine is restructuring. Restructuring. Restructuring, this refers to change in capital structure of a company. In some cases, ownership structure may also be changed. I told you that restructuring refers to change in capital structure of a company. In some cases, ownership structure may also change. Number two is reorganization. Reorganization. This means to rearrange the business. To rearrange the business by adding adding other lines of business to the existing one, of business to the existing ones, existing one. So, e.g., examples of reorganization is diversification. Diversification. I said reorganization means to rearrange the business by adding other lines of business to the existing one. When you rearrange the business by adding other line of business to the existing one, that is said to be reorganization. So now, the number 3 term I'm going to examine is reconstruction. What do you mean by reconstruction? Reconstruction. This means to build or create again. To build or create again the business entity. To create again the business entity. Reconstruction means to build or to create again the business entity and the capital structure of the organization. And the capital structure of the organization. I said reconstruction means to build or create again the business entity and the capital structure of the organization. Other forms of restructuring. Other forms of restructuring include number 1, management buyout. Management buyout, MBO. Management buyout, this is the purchase of all or part of the business. The purchase of all or part of the business from its owners, by its managers. Management buyout is the purchase of all or part of the business from its owners by its managers. The directors of a subsidiary company in a group might buy the company from the holding company with the intention of running it as a proprietor of a separate business entity. The directors of a subsidiary company in a group might buy the company from the holding company with the intention of running it as a proprietor of a separate business entity. That is management buyout. Number 2 is management buy-in. Management buy-in. Management buy-in. This is when the team of external managers mount a takeover bid, and then run the business themselves. I said management buy-in is when the team of external managers mount a takeover bid and then run the business themselves. Management buy-in might occur when a business venture is running into troubles. When a business venture is running into trouble and a group of outside managers sees this as an opportunity to take over the business and restore its profitability. I said management buys in is when buys in might occur when a business venture is running into trouble and a group of outside managers sees their trouble as an opportunity to take over the business and then restore its profitability. Number 3 is leverage buys out. Leverage buy out. Leverage buys out. This is where the investor group buys out the public stockholders. Management buys out, leverage buys out. This is where the investor group buys out the public stockholders, where they buys out their debt. That is leverage buys out. Leverage, that is geared debt, where they acquire the debt of that entity. That is leverage buy out. So now I want to examine the causes of financial distress. Causes of financial distress. Causes of financial distress in business. Number 1, we have revenue failure. Revenue failure. Revenue failure is the loss of revenue. This is the loss of revenue. The loss of revenue might be as a result of the loss of orders by the customers. This might be as a result of the loss of orders by the customers. That is revenue failure. Number 2, we have cost failure. Cost failure is caused by weak cost control. This is caused by the weak cost control. It is caused by the weak in cost control, where cost is not effectively controlled. So that means there is a cost failure. Number 3 is failure in asset management. Failure in assets asset management. Failure in asset management. When assets are not used efficiently, this is where assets are not used efficiently or effectively. That is, e.g., failure to invest in appropriate technology. Or poor working capital. So, where assets are not, failure to invest in appropriate technology or poor working capital management. Poor working capital management. Number 4 is failure in liability management. Failure in liability management. Failure in liability management. That is, failure to manage the company's failure to manage the company's relationship with the money market, Failure to manage relationship with the money market, or weak control of interest. Weak control of interest rate, risk, and currency risk. That is failure in liability management. That means failure to manage the company's relationship with the money market, weak control of interest rate, risk, and currency risk. Number 5, failure of capital management. Failure of capital management through either under or over capitalization, e.g., through under or over capitalization, or poor management of the company's relationship with the capital markets. Failure of capital management, for example, through under or over capitalization, or poor management of the company's relationship with the capital market. These are the causes of financial distress. Practical examination requirements. Practical examinations requirements. You may be asked to determine the amount by which each of the stakeholders will receive in event of liquidation, or will they support restructuring? I want you to know that when a business is to restructure, there are a class of people that will not want to favor restructuring. That is why the burden of restructuring will be transferred on the ordinary shareholders. It is the ordinary shareholder that will bear the burden. The whole of the losses will be transferred on the ordinary shareholders. But upon liquidation, this is the order of settlement. Order of settlement in event of liquidation. That order is Cypre de Bunch. Cypre de Bunch. So I'm using these acronyms. Cypre de Bunch. The SC stands for Secured Creditors. This class of people will not want to support restructuring. They will prefer liquidation. That is why their debt or what the entity is owing them have to be met in full. Secured creditors. Since the class of creditors are specific, they are pledged on the specific asset of the company. They are the creditors that are pledged on specific assets of the company. That is, the assets of the companies are used as a collateral for such loans. So these are the people that will be settled first in the event of liquidation. After the claims of the secured creditors have been met, the next class of creditors that will be settled is preferential creditors. That is PRE. PRE stands for Preferential Creditors. So these set of people include the tax due to government, the salaries or wages of the employees. Then let me include liquidation expenses. Liquidation expenses. These are a class of people that will be settled after the claims of the unsecured credit and after the claims of the secured creditors have been met. After the preferential creditors, we have DEB, which is debenture. DEB stands for debenture. Debenture. But the debenture, what will be considered as debenture here is a floating one. Where you are given debenture in the question, and if it is not floating, it will not be considered here. That is, any floating liabilities will be considered. So examiner will indicate where it is a floating debenture. So after DEB, which is debenture, the next class of creditors that will need to be settled is unsecured creditor. UN stands for unsecured creditors. Any liabilities that are not pledged on any specific asset of the company are said to be unsecured. Liabilities that are not pledged on specific assets of the companies, we regard them as unsecured creditors. And this may include bank overdraft, where it is not pledged on asset, the trade payables, accrued expenses. Those liabilities that are not pledged on any asset or on a specific asset of a company, we regard them as unsecured creditors. They are the class of creditors that will be settled after floating debenture. Then the last set of people now, which is SH here, that stands for shareholders. Shareholders or contributory or contributory. So the shareholders, so this may be ordinary shares or preference shares. Ordinary shares or preference shares. And where preference shares are to be ranked prior to ordinary shares, that means the preference shares will be settled before the claim of ordinary shareholders will be met. But where the preference shares are to be ranked in pari passu with the ordinary shares, their claims will be settled simultaneously. The claims of both the ordinary shareholders and preference shares or preference shareholders will be met simultaneously. That is where they are to be ranked in pari passu, where the preference shares is to be ranked in pari passu with the ordinary shares. But where preference shares are to be ranked prior to the ordinary shareholders, the claims of the preference shareholders will be ranked before the ordinary shares. So this is the order of settlement in the event of liquidation. Now, before we take a practical examination, I want to note that upon liquidation, it is the realizable value of the assets. Liquidation. Upon liquidation, the assets of the company will be realized. We now have realizable value of the asset, realizable value of the asset, They are more realized from the sales of the assets. You now use the proceeds, total cash the entity have, now use it to settle the creditors. Remember, I've told you that the order of settlement is separate the bunch. That is, secured creditors first. You settle the secured creditors. After the secured creditors have been settled, if any balance is left, then preferential creditors follow. Preferential creditors follows. And after the preferential creditors have been settled, if any money is left again, floating debentures would be settled. After the floating debentures have been settled, if any balance is left, remember the formula is separate the bunch. After the floating debenture, the next one is unsecured creditors. After the unsecured creditors have been settled, if any money is left, the remaining ones goes to the shareholders. We have the shareholders. This is the order of settlement in the event of liquidation. Let's take a work example. BDJR Computers Global is a company that manufactures a range of personal computers that are sold to retailers and also directly to individuals and businesses through online sales. Due to a number of technological problems, the company's sales have fallen significantly over the last year, resulting in an operating loss of $50,000. The company has, as a result, built up losses on its retained earnings, and there is a significant risk of insolvency. To avoid this, the company's financial advisors have proposed a scheme of reconstruction. Balance sheet at 3112x9. Statement of financial position. The amount is in thousands of dollars. We have assets. Non-current assets 1,100. Current assets, which include inventory 410, receivables 220, cash 25. The total of current asset is 655. Current asset plus non-current asset giving us the total assets of 1,755. Equity and liabilities. Share capital $1 shares 200. Retained earnings 50. Deficit. Total equity 150. Non-current liabilities. Bank loan 1,200. Current liabilities. Payables 205. Overdraft 200. Total current liabilities 405. Total equity and liabilities 1,755. If notes 1, if the company was liquidated, all of the assets could be sold for their book values except for inventory. Following a review, it was discovered that $220,000 of the inventory is obsolete, but the remainder could be sold for book value. In addition, $90,000 of the receivables is irrecoverable. 2. To be successful, a scheme of reconstruction would need to raise $195,000 of cash to invest in new manufacturing processes. 3. Given the risk attached to the company, any providers of new equity capital will require a return of at least 18%. 4. The current interest rates are 8% on the bank loan and 6% on the overdraft. The bank loan is secured. The following scheme of reconstruction is proposed. 1. The nominal value of each existing share will be reduced to 50 cents. 2. Goodwill Bank, who provide both the overdraft and loan, will convert half of the overdraft and 1/3 of the loan into a total of 200,000 new shares. Note 3. New finance of $400,000 will be raised from a venture capital company, PC Ventures, who will buy new shares for $1.25 per share. In addition to investing in the new manufacturing process, the finance will also be used to pay payables. Note 4. Note 4. Following the reconstruction, it is expected that the company will generate $320,000 of profit before interest and tax per annum. Tax is payable at 28%, assuming no tax losses required. A. Determine how much each of the original investors is likely to get in the event of liquidation. B. Following the reconstruction, calculate the expected EPS and the return on equity to the venture capital company, and advise as to whether the venture capital company is likely to invest in BDJR computers. C. From post-reconstruction EPS calculation above, calculate the effective return that the bank is likely to receive on the capital converted into equity. D. Determine whether the existing ordinary share holders and the bank are likely to accept the scheme. That is the question. This question is obtained from ACCA study test by Kaplan, Advanced Financial Management. So, now let's have the solution to the question. Solution. The name of the company is BDJR Computers Global. In requirement A, that to determine how much each of the original investors is likely to get in the event of liquidation. So on liquidation now, you have to determine how much each investor will get. I've told you that on liquidation that we are going to use the realizable value of assets. Now, how much will the assets be realized? Now, note 1. If the company was liquidated, all of the assets will be sold for their book values. You are going to realize them for their book value, except for inventory. Following a review, it was discovered that 220,000 of inventory is obsolete, but the remainder could be sold for book value. In addition, 90,000 of receivables is irrecoverable. So we only have exception to both the inventory and the receivables. Now, back to the statement of financial position. The first asset we have is non-current asset. Non-current assets, and that will be realized for 1,100. After non-current assets, the next asset we have current assets, which include inventory. So we have inventory. The book value of inventory is 410. And we were told that following the review, it was discovered that 220 of the inventory is obsolete. 220,000 is obsolete. We have the obsolete inventory. Obsolete. 220. If you subtract 220,000 from 410, then you'll be left with 190. The next asset is receivables. Receivables is having a carrying amount of $220,000. Receivables with its carrying amount of $220,000. Back to the note. If the company was liquidated, all of the assets could be sold for their book values, except for inventory. Following the review, it was discovered that $220,000 of the inventory is obsolete, but the remainder could be sold for book value. In addition, $90,000 of the receivables is irrecoverable. Since $90,000 is irrecoverable, in order to arrive at the carrying amount of receivable, you are going to subtract the one that is irrecoverable. We have irrecoverable debt of $90,000. By the time you subtract $90,000 from 220 minus 90, that gives us 130. We have the realizable value of the receivable to be 130. After receivables, the next asset is cash. We have cash of 25,000. Cash 25,000. These are the assets we have. Now, having considered all the assets, then let's sum up the assets in order to get the total realizable value of all the assets. The first asset is non-current asset with the realizable value of 1,100. So we have 1,100 plus 190 plus 130 plus 25. All the assets realized 1,445. 1,445. Then the proceeds from the realization will now be used to settle the liabilities. Now let's check the liabilities we have. The first item is share capital. Then share capital is an equity, retained earnings is an equity. Then we have the total equity to be 150. Non-current liabilities, which include bank loans. Now let's go through the footnote. Note 2. To be successful, a scheme of reconstruction will need to raise $195,000 of cash to invest in new manufacturing processes. 3. Given the risk attached to the company, and any providers of new equity capital will require a return of at least 18%. 4. The current interest rates are 8% of the bank loan and 6% on the overdraft. The bank loan is secured. You have been told that the bank loan is secured. I've given you the order of settlement, which I termed separate the bunch, which is secure creditors. You have been told that the bank loan is secure, so we have secured creditors, which include bank loan, and that will be settled first. And bank loan amounted to 1,200. 1,200. Their claim will be met in full. And when bank loan is settled, then if you subtract 1,200 from 1,445, you'll be left with 245. After secure creditors, we have preferential creditors, and there is no preferential creditors. Then we have debenture, which is floating, and there is no floating debenture. So the next one is unsecured creditors. Now let's go through the liabilities. We have current liabilities, which include payables of 205 and overdraft of 200. These two liabilities, they are not pledged on any specific asset of the company. Since they are not pledged on specific asset of the company, they are therefore said to be unsecured. So we have unsecured creditors, which include, the first one is payables. Payables of 205, payables 205. After payable, we have overdraft of 200. Overdraft of 200. Then we have overdraft of 200. Then that is totaled 405. If you subtract that 405, if you subtract it from 245, we have 245 minus 405, then you'll be having 160. The cash available of 245 is not enough to meet the claim of the unsecured creditors of 405. That means the unsecured creditors can only get 245 from the 405 they were owed, that was owing to them. That means the unsecured creditor will lose 160. Now, back to the requirement. You have to determine how much each of the original investors is likely to get. How much each of the original investors is likely to get in the event of liquidation. So unsecured creditors will only get 245 from 405. Unsecured creditors. Unsecured creditors will get 245 out of 405 times 100. So unsecured creditors will get 60%. So they will get 60%. So if unsecured creditors will get 60%, unsecured creditors will get 60% of the amount owed. Unsecured creditors will get 60% of the total amount owed, of the total amount owed. 2. The claims of the unsecured creditors were not met in full. That means ordinary shareholders will receive nothing. Ordinary share capital holders will receive nothing. So they will not receive anything, since there is no surplus left after the unsecured creditors have been settled. And besides, unsecured creditors were not settled in full. So ordinary shareholders will receive nothing. So back to the requirement B. The requirement B. Following the reconstruction, calculate the expected EPS and the return on equity to the venture capital company, and advise as whether the venture capital company is likely to invest in BDJR computers. Now, EPS. What is EPS? Earning per shares. Earning per share EPS equals to part profit after tax, no preference shares. So if you have preference shares, you subtract preference shares dividend over number of issue ordinary shares. So you will need to calculate the post reconstruction profit after tax, or BDJR computers. Post calculation of post reconstruction part of, that is profit after tax, of BDJR company. So since it is the post following the reconstruction, it is the post reconstruction EPS you want to calculate. That means the profit after tax you will need is the profit after tax after reconstruction, and the number of ordinary shares you will equally need will be the number of ordinary shares after reconstruction. Now back to the note 4. Following the reconstruction, it is expected that the company will generate $320,000 of profit before interest and tax per annum. So they will generate profit before interest and tax of $320,000. Tax is payable at 28%, assuming no tax losses. So profit before interest and tax, which amounted to $320,000. Then you now deduct interest. What are the interests to be charged? Back to note 3. Given the risk attached to the company, any providers of new equity capital will require a return of at least 18%. There is no interest in note 3. Note 4. The current interest rates are 8% on the bank loan and 6% on the overdraft. So interest on loans, interest on loans, you were told it should be 8%. 8% of the loan. So how much is the loan? The loan amounted to 1,200. Note 2. Goodwill Bank, who provide both the overdraft and loan, will convert half of the overdraft and 1/3 of the loan into a total of 200,000 new shares. That means following the reconstruction, half of the overdraft and 1/3 of the loans will be converted to total of 200,000 shares. So that means you'll be left with half of overdraft. Then you will also be left with 2/3. Since 1/3 of the loans has been converted to shares, then that means you'll be left with 2/3. So for the loans now, the loan interest rate is 8%. The current interest rates are 8% on the bank loan and 6% on overdraft. So interest on loans, interest on overdraft. Overdraft interest rate is 6%. So how much is the loans and how much is the overdraft? The loans amounted to 1.2 million and overdraft, bank overdraft, amounted to 200,000. So loan 1.2 million, overdraft 200,000. Remember from the note 2 here that Goodwill Bank, who provide both the overdraft and loan, will convert half of the overdraft and 1/3 of the loans into a total of 200,000 shares. Half of the overdraft has been converted to shares. That means you will be left with another half. Then 1/3 of the loans has been converted to shares. So that means you'll be left with 2/3 as loans. So now let's calculate that 8% of 1.2 million and calculate 2/3 of that. Then the interest on loans is 64,000. Then interest on overdraft, 6% of 200,000 and half it. Then you'll be left with 6,000. The interest on overdraft is 6,000. So now let's subtract that. 320,000 minus 64,000 minus 6,000. Then you'll be left with 250. That 250 is the profit before tax. Profit before tax is 250. Then now let's calculate tax expense. And what is the tax rate? Back to the question. Note 4. Following the reconstruction, it is expected that the company will generate $320,000 of profit before interest and tax per annum. Tax is payable at 28% per annum. Assume no tax losses. The tax rate is 28%. Now let's calculate 28% of 250. 250,000. 28% of that. Then you have the tax of 70,000. By the time you subtract 70,000 from 250, you'll be left with 180,000. The 180,000 is the profit after tax. Profit after tax amounted to 180,000. Having calculated that, I told you that 2 variables are required for the purpose of EPS calculation. You've got the numerator, you've got the part, then you are left with number of issue ordinary shares. What is the post reconstruction number of ordinary shares? Following the reconstruction, how much is the total number of shares now the entity will be having after the reconstruction? Number of post-reconstruction ordinary shares now. Number of post-reconstruction ordinary shares. And that includes the existing ordinary shares. Existing ordinary share, that is 200,000. Existing ordinary shares, that is 200,000. 200,000. Now back to the note. Note 2. Goodwill Bank, who provide both the overdraft and loan, will convert half of the overdraft and 1/3 of the loan into a total of 200,000 new shares. So, bank, both loans and overdraft, which was converted to shares, and that was converted to 200,000 shares. Note 3. New finance of 400,000 will be raised from the venture capital company, PC Ventures, who will buy new shares for $1.25 per shares. In addition to investing in new manufacturing process, the finance will also be used to pay payables. Now they want to, how many shares? If a share were bought for 1.25 and the total of 400,000 was paid to acquire the shares, how many shares will be bought for 400,000? If the consideration for each share is $1.25. Now, venture capital company. Venture capital company purchasing shares worth of 400,000 at $1.25 each. So, 400,000 divided by 1.25 That gives us 320,000. How much will be the total shares of the company after reconstruction? 200,000 plus 200,000 plus 320,000. That is total 720,000. Therefore, the post-reconstruction EPS forecast now will be profit after tax, and the profit after tax as calculated is $180,000. $180,000, and number of issued ordinary shares is 720,000 shares. So we have 180,000 divided by 720,000, and that gives us 25 cents. 25 cents. That is the post reconstruction EPS. Back to the requirement B. Following the reconstruction, calculate the expected EPS, and that has been calculated. And the return on equity to the venture capital company. So you need the return on equity. Return on equity to venture capital company. What will be the return on equity to venture capital company? So the return on equity will be, so the EPS as calculated, which is 25 cents, and the consideration payable by the venture capital company for each share is $1.25. If you convert it to cent, if $1 is 100 cents, and $1.25 will be 125 cents. So since this is in cent, that is why $1.25 will need to be converted to cent as well. So that will be 125 cents times 100 over 1. So 25 divided by 125 times 100. That gives us 20%. Return on equity to venture capital company is 20%. And the return on equity to the venture capital company. And advice as whether the venture capital company is likely to invest in VDJR computers. Now, to be able to advise, let's go back to the note. So, what is their target return? Post-reconstruction target return. Given the risk attached to the company, any providers of new equity capital will require a return of at least 18%. Since they are expecting at least 18%, and the post-reconstruction EPS is 20%, which is above 18%. Since this is the above target return of 18%, since this is above the target return of the 18%, therefore it is acceptable to the venture capital company. Since this 20% is above the target return of 18%, therefore it is acceptable to the venture capital company. Since the return on equity to venture capital company of 20%, 20% as calculated above, is above 18% target return, therefore the investment is acceptable to venture capital company. That is the answer to the requirement B. B. From the post-reconstruction EPS calculation above, calculate the effective return that the bank is likely to receive on the capital converted into equity. Remember, note 2. You were told that Goodwill Bank, who provide both the overdraft and loan, will convert half of the overdraft and 1/3 of the loan into a total of 200,000 new shares. Now, requirement C. So, capital forgone by Goodwill Bank. So, overdraft and loans. So, you were told that Goodwill Bank, who provide both the overdraft and loan, will convert half of the overdraft and 1/3 of the loans into a total of 200,000 shares. Half of the overdraft and 1/3 of the loans. And how much is the overdraft? Bank overdraft amounted to 200,000, while the loans, bank loan, that is 1.2 million. Overdraft 200,000, loans 1.2 million. So the capital forgone now, half of 200,000, that will be $100,000. 1/3 of 1.2 million, that will be $400,000. So when you sum it up, you have the total of $500,000. That is the overdraft and the loans converted to shares. Number of shares in return, or number of shares taken in return. How many shares did the bank take in return for both the overdraft and the loans? That is 200,000 new shares. 200,000 shares. And how much is the return on the 200,000 shares? So the return now on the shares, as calculated, the post-reconstruction EPS was 25 cents per shares. So we have 25 over 100 times 200,000 shares. That gives us 50,000. So, and you were asked to calculate from the post-reconstruction EPS calculation above, calculate the effective return that the bank is likely to receive on the capital converted into equity. So, effective return which will be received by the bank on the capital converted into equity. You know, the returns on the shares, on the 200,000 shares, that is 50,000. And the capital converted or forgone, that amounted to 500,000 times 100. That gives us 10%. That is the answer to the requirement C. Now, requirement D. Determine whether the existing ordinary shareholders and the bank are likely to accept the scheme. You have to determine whether the existing shareholders and the bank, if they are likely to accept the scheme of reconstruction. We want to examine the acceptability acceptability of the scheme. Acceptability of the scheme. Existing ordinary shareholders. Existing ordinary shareholders. Existing ordinary shareholders. Liquidation. If the company is liquidated, the existing ordinary shareholders will gain nothing. If the company is liquidated, the existing ordinary shareholders will gain nothing. That is from the requirement A. We have answered. From the answer to the requirement A, we've concluded that if the company goes on liquidation, or if the company is liquidated, we concluded that the existing ordinary shareholders will gain nothing. But upon reconstruction, in a reconstruction scheme, the existing ordinary shares, will lose control of the company. They will only have 200,000 shares out of the total shares of 720,000 of the company, giving us 200,000 divided by 720,000. 200,000 divided by 720,000 times 100. That will be 28%. They'll be having only 28% of the equity. And 28% is not enough to give them a control. But they will still earn return of 25%. But they will still earn return of 25 cents. 25 cents. So the existing ordinary shares will favor the scheme. 25 cents. So they will favor the scheme. That is, they will prefer the scheme to be implemented, because if the business goes on liquidation, nothing is coming to them. They will lose everything they have. But if this scheme is implemented, they will only lose control of the company, but they will still be expecting some returns in the future. So that is why they will prefer the scheme to be implemented. So now let's look at the position of the bank. If the business goes on liquidation, so position of the bank upon liquidation, the bank will still be able to recover the whole of the loans. They will still recover the whole of the loans. The bank will recover 100% of the loans and 60% of the bank overdraft. If the business goes on liquidation, but following the scheme of reconstruction, the scheme of reconstruction, the bank will only get the return of 10% on the capital converted to equity and continue to receive interest on the loans at the existing interest rate. And also the bank overdraft. That means they will still be receiving interest on the overdraft at the existing interest rate. Given that 1/3 of the secured loan is converted into equity, given that 1/3 of the secured loans is converted into equity, which only earn return of 2% of 10%, which is only 2% above the loan interest rate. Therefore, the bank may not accept the scheme. So that is the solution to the question. So this is the end of this presentation on corporate failure and restructuring. More are still coming. Other areas not yet examined on corporate failure and restructuring and other important topics in financial management or advanced financial management or strategic financial management will also be examined. Thanks for watching ACCA.